Okay. Next is section 143.3, which talks about regular or scrutiny assessment. Okay. On the day specified in the notice issued under subsection 2 or as soon as afterwards as may be, after hearing such evidence as the assessee may produce and such other evidence as the assessing officer may require on specified points, and after taking into account all the relevant material which he has gathered, the assessing officer shall, by an order in writing, make an assessment of the total income or loss of the assessee and determine the sum payable by him or refund of any amount due to him on the basis of the assessment. So one important thing here is that the assessment can be even for the benefit of the assessee, right? There are some assessments in which the assessee, the assessment cannot be done for the benefit of the assessee. Like for example, under section 144, the best judgment assessment cannot be for the benefit of the assessee, which means a refund of a greater amount cannot be done. If he is already having a refund, just by doing best judgment assessment, the assessing officer will not enhance the refund or he will not reduce the tax liability after best judgment assessment. But under 143.3, a refund also can be made to the assessee, which means it can be for the benefit of the revenue or it might also be for the benefit of the assessee. That is one important thing to remember. Number one. Number two, let's read the analysis part now. Point number one, where the assessee has not furnished his return of income, then notice under section 143.2 cannot be issued to him, and consequently the assessment under 143.3 is not possible. This is because the notice under 143.2 can be issued only if the assessee has filed the return under 139 or in response to a notice issued under 142.1. Important. If the return itself has not been filed, then assessing officer will not go ahead with the route of 143.2 or 143.3. Understand that. But sir, then in that case, if the assessee was supposed to file return of income and he did not file, what will happen? Then in that case, because he has already been served a notice under 142.11, 142.11, assessing officer asked the assessee to file return, he did not file, then the assessing officer in such cases will not do any assessments. After that, the assessing officer will straight away go ahead with best judgment assessment under section 144. Understand that. Okay, because you need to understand one thing. When the processing of return is done under 143.1, and if the assessing officer feels that some income has been suppressed or some liabilities have been exaggerated, only in those cases they will go through the route of picking up the case for scrutiny or regular assessment. But where the return has not been filed in first place, then the question of scrutinizing the return does not arise. Then the first thing is that the assessing officer has to do the assessment by applying their best judgment that is based on evidence and documents collected by them. In that case, they will go through the route of 144. Okay. If the assessment under 143.3 is made without serving a notice, that question cannot arise, because I told you any assessment done, first a notice got to be served on the assessee. So an assessment under 143.3 which is done without serving a notice will be obviously void ab initio. What does that mean? From the very time it started, it is invalid. It does not hold good in the eyes of law. Okay, I hope this is clear. Next, if the assessment under 143.3 is made in pursuance of a notice under 143.2 which is served after the expiry of 6 months, then also even if you serve the notice but the notice is served after a period of 6 months, then anyways the notice does not hold good. And if the notice does not hold good, then in that case the notice is invalid, and any assessment done in pursuance of that issuance of notice will also be invalid. I hope this is clear. Okay, so what are the reasons why a case will be picked up? Point number 4 and 5, you can just read it. I've already discussed with you. Just read it, please. I have already discussed. Point number 6 also you can read, sir. I have discussed. What is the time limit for the completion of assessment under section 143.3? 12 months from the end of the relevant assessment year. under 143.3 or even under 144, it is 12 months from the end of the relevant assessment year. After that, what is written in bracket, please strike it off. That is not applicable for you. What is applicable is the total period of 12 months from the end of the relevant assessment year. Within 12 months, they have to complete. Where are these time limits given? It's given in section 153(1). If you see below that, this case law of Goetz Limited, the Supreme Court judgment was given. What SSE did, he felt there is some revision to be done in the return of income. So he writes a letter to the assessing officer. So in this case law, Supreme Court made it clear that a letter will not do. If you feel some income has been over-reported or expenses have not been reported or incorrect claims are made, you will have to do a revision of your return. A revised return needs to be filed under 139(5). Writing letter to the assessing officer will not be considered as valid in the eyes of law. Okay, that's what is written. Just read it once, please. Next is best judgment assessment. We have been discussing this since long. Okay, so best judgment assessment. There are certain circumstances in which the best judgment assessment can be initiated by the assessing officer. Number one, you are required to file a return of income under 139(1). You did not do that. A notice was issued to you under 142(1)(1) or under section 142(1)(2). You still did not file your return, or you failed to comply with the terms of the notice being served on you. You did not comply with the special audit which was required under 142(2)(a). We discussed this. Or you failed to comply with all the terms of the notice issued under 143(2). In all these cases, the assessing officer can go ahead and do the best judgment assessment. Okay. Then the assessing officer, what assessing officer will do? He will, based on whatever data they have gathered, whatever material they have gathered, based on that, they will do the best judgment assessment and determine the tax payable by the SSE. Okay, here the language does not say or refund grantable to the SSE. Because I told you 144 will not be acting for the benefit of the SSE. This can only be for the benefit of the revenue. Okay. The assessing officer shall not make the assessment unless he gives the opportunity of being heard to the SSE. Opportunity of being heard shall be given by serving a notice upon the SSE in which he shall be asked to show cause as to why best judgment assessment should not be made on him. The notice is given under section 144. Already told. I have told you almost everything that we are going to study. You remember this? I told you before the best judgment assessment is done under 144. First they will have to serve a show cause notice on the SSE that why the best judgment assessment should not be done against the SSE. But there is one exception to this. What is the exception? If under 142(1)(1) a notice was already served on the SSE, if under 142(1)(1) a notice was already served on the SSE, then in that case the notice, the show cause notice under 144 is not required. Do you remember this? So that is given in point number 2. The show cause notice is not required to be issued where a notice under 142(1)(1) has already been issued to the SSE and SSE has not complied with the notice under 142(1)(1). That's an exception, right? If the assessment has been done under 144 without issue of notice, it will be invalid. And point number 2 is important. Just read it and see if you have understood. Please read it. I've already discussed from my side. Look at question number 6, please. Assessment year is 1920, due date is 39/19, and the return of income is not filed till 31st December 2019. On 31st December, the assessing officer issues a show cause notice under section 144 to the SSC to show cause as to why best judgment assessment should not be made on him. Is the time to file belated return over? Answer is no. SSC can still file belated return under section 139(4). Okay, so why best judgment assessment should not be made on him for failure to file the return of income under 139(1) and 139(4). In the said show cause notice, the SSC is asked to file his reply by 30th of January. Case 1, the SSC files a reply to the show cause notice on 15th January, which is within the time limit given, stating that because of death in the family, he was not able to file the return. And along with that, he also files his return of income on 15th January. What will happen? Proceedings, let's write, proceedings under section 144 will be dropped. As SSC produces genuine reasons for his failure to file return. Proceedings under 144 will be dropped as SSC produces genuine reasons for his failure to file return. And return filed on 15/1/20 will be accepted. Return filed on 15/1/2020 will be accepted. Second case, the SSC does not reply to the show cause notice or his reply is not satisfactory. That is, he gives no valid reasons for failure to file return of income. The SSC files a return of income on 25th January. What will happen? Okay, he does not give any reasons, but he files his return of income on 25th January. Is the return valid in first place? The answer is yes, the return is valid because it is filed within the end of the assessment year. So it is a belated return and it is a valid return. But when he has been asked the reason why the return was not filed within the due dates given under 139(1), he should have come up with some reason. So assessing officer has all the rights to reject this return and continue with the proceedings under 144. And that return, which is filed on 25th January, all the documents and data from that can be utilized for the best judgment assessment. Okay. Even if the belated return is filed within the time limit specified, assessing officer has all the rights to reject that return and still go ahead with best judgment assessment because SSC has no good reasons for not filing return within due dates specified under 139(1). Just see this. Okay, I hope you have understood this. Next is section 145, that is method of accounting. Part of it we already discussed yesterday. Some part of it we discussed when we were studying PGBP. I told you very clearly, income under the head PGBP only for these two heads. Only for these two heads. If you want, you can follow the mercantile basis of accounting or cash basis of accounting as you wish. But once you have followed a particular method, you should continue following that method for the subsequent years. And any change in method should be notified to the assessing officer, and there should be valid reasons for you to change the method of accounting. Number one. Number two, when you're filing your return using any of the methods, the ICDS which has been notified should be followed. If the SSC is not following the ICDS, then also the assessing officer has the rights to do best judgment assessment under section 144. Point number three, in respect of PGBP or IFOS, it is very much possible that for one of your business, you follow mercantile basis and for the other, you follow cash basis. Similarly, under income from other sources, one source of income you might be using cash basis and maybe you are using accrual basis for the other income. Point number four, it is possible that if you follow a specific method, it might result in lower tax liability. It might increase your losses or reduce your income, but that cannot be used by the assessing officer against you, which means, in simple terms, you can follow cash basis of accounting. If it results in lower taxability in a given year, assessing officer cannot challenge it. However, if you follow cash basis in a particular year, then you got to follow cash basis in subsequent years until and unless you have a solid reason of why you are converting to the accrual basis of accounting. If there are any lapses in this, if there is any lacuna in the way you are reporting your income, then assessing officer has all the rights to apply best judgment assessment under section 144. Okay, so this is section 145. You can just revise it and then we will discuss further. Okay, guys, if you can please come to page 240. Page 240, we have to discuss this point, which is section 144C, the dispute resolution panel. So DRP is basically a team of three commissioners. Okay, there are three commissioners who will form the DRP. Let me just show that to you where it is written. And under what circumstances DRP will be brought in, that I have to discuss with you. So the entire thing given under section 144C basically talks about the procedure which needs to be followed by the DRP and by the assessing officer. What are the obligations of the assessing officer and the SSE? Okay. So DRP is a very, very powerful section, and whatever DRP has decided will be binding on the assessing officer. That is, once a decision has been made by DRP, then that cannot be challenged by the department. So the question number one is, okay, I'm not able to find, yeah, this is here. If you look at, so we will have to start from the last part of this, because I first want to make you understand who forms the DRP and under what circumstances the application needs to go to DRP, where do they have the powers, and how strong are their powers. That first I need to make you understand. The procedure is not that important. Yes, from procedure also question can come, but that is more of a mechanical thing. Let us first discuss about the technical side of it. So if you can please come to page number 242. Page number 242, and you find it over here that DRP means a collegium comprising of 3 commissioners of income tax constituted by the board for this purpose. Okay, who are the eligible SSE who can make a reference to DRP? Eligible SSE means any person in whose case the variation referred to in subsection 1 arises as a consequences of the order of TPO, Transfer Pricing Officer, passed under section 92CA. Now, when we are studying the international taxation, one of the important chapters which we cover in international taxation relates to transfer pricing. So, in case of foreign transactions, there will be transactions will be there with the associated enterprises, and that is where the concept of transfer pricing will arise. That is, we will have to look at those transactions which are happening between associated enterprises, and we have to see if those transactions are being done at a price which is prejudicial to the interest of the revenue. So generally in case of associated enterprises, the transactions are planned in such a manner that the companies will end up benefiting by saving on their taxes. That is where the transfer pricing officer comes in. He will compare this price at which transaction has taken place between associated enterprises. He will compare this transaction with the transaction with any third party. That is called as the arm's length price. ARM, arm's length price. The price at which the transaction would have happened between two unknown entities, not associated entities, that price will be taken, and accordingly that price will be implemented on the price on the transaction between two associated enterprises. This is the discussion we are going to do later on, but because a reference has been made to it, so it was important that I give you a glimpse of it. Okay, so I hope this is clear to you. So what am I saying? If there is any person in whose case the variation has been reported by transfer pricing officer, which means in my return, a part of my return has been modified based on the report given by transfer pricing officer to the assessing officer. Part of my return has been modified based on the report given by TPO, Transfer Pricing Officer, to the assessing officer. In those cases, we can go to the DRP, Dispute Resolution Panel, under 144C. Or if it's a foreign company, in respect of foreign company, whatever be the transaction, it has to go to DRP. Okay. So for foreign company, there is no criteria, but for the person other than foreign company, the revision in return, the modification in return should have happened on the grounds of TPO, Transfer Pricing Officer. Then only that can be reported to DRP. In the analysis, we will understand this better. The assessing officer is bound to follow the procedure of forwarding a draft assessment order referred to in section 144C for reference to the DRP in the following cases. If it's a number one, is bound. Okay, bound means obligation is there. Bound means obligation is there. There is no choice. Assessing officer has to follow the procedure laid down in section 144C in the following circumstances. If it's a foreign company, If assessing officer wants to increase the returned income or decrease the losses of a foreign company, he's bound to follow the procedure laid down in section 144C. It is not necessary that variation should have been made on account of order of TPO. Even if the variation is done without the involvement of transfer pricing officer, assessing officer normally, in case of foreign company, wants to increase their tax liability as a result of reduction in losses or increase in income, they will have to follow the procedure laid down in the section 144C. Okay. Therefore, in case of a foreign company, whether the variation are there on account of order of TPO or not, assessing officer will have to follow the procedure laid down in 144C. Sir, what is the procedure? Procedure part I will discuss later. First, I should tell you when DRP should be spoken to, when we have to knock the doors of DRP. First, you need to understand that. Only after that we can understand the procedure. Okay, procedure is mainly the timelines, nothing else. Assessing officers. So in case of foreign company, one crux of discussion is in case of foreign company, whether the revision is done by the assessing officer at his own motion or based on the transfer pricing officer's report, does not matter. In all the cases, they have to follow the procedures laid down in section 144C. Remember that. In case of any other SSC, what will happen? In case of any other SSC, the assessing officer is bound to follow the procedures laid down in 144C. Remember this, only if the variation in the total income arises on account of transfer pricing officer, order of transfer pricing officer passed under section 92CA. Over there, only if in case of any other SSC other than foreign company, if the modification of the return of the SSC happens on account of report of TPO, only then in that case, the assessing officer has to follow the procedure laid down in 144C. Okay. If there are no additions on account of order of TPO, the assessing officer cannot follow the procedure laid down in section 144C. If assessing officer makes addition on account of order of TPO and some other additions which are not on account of transfer pricing, then also is bound to follow the procedure laid down in section 144C. Which means if 50% modification is done based on report of TPO and 50% is done based on their own motion, then also they are bound to follow 144C. Any modification in the return of any person other than a foreign company, any modification in the return of a person other than a foreign company on the account of the TPO, report of TPO, they are supposed to follow the procedure laid down in 144C. I hope you remember that. However, as per CBDT clarification, it is not mandatory for the SSC to file objection with DRP against the draft assessment order of assessing officer. The SSC can directly go to CIT appeals, okay, against the order filing the objection with DRP. Instead of going to the DRP, they can also go to the CIT appeals, or they can even go for revision application to the Commissioner of Income Tax against any assessment. So for SSC, they are not obligated, but for the assessing officer, they are obligated. Now, very, very important. As for Finance Act 2016, department cannot challenge the directions of DRP. Department is bound by the directions of DRP. Department will have to follow the directions given by DRP. So what is the conclusion of our discussion? Foreign company, any modification in their return which enhances the tax liability of the foreign company, assessing officer has to present the draft order to the DRP. DRP is a team of 3 commissioners of income tax. Any other person other than a foreign company, if modifications are done based on the report of transfer pricing officer, bound to follow the procedure laid down in section 144C. SSC, not bound by 144C. He can alternatively go to CIT appeals. Once the orders are given by the DRP, department has no alternative left. They have to abide by it. Matter close. Okay. The procedure, I don't have to talk much about the procedure. You can come back to page 240 and look at the procedure. So the procedure part is something which you can read by yourself. There is no value addition to be done at my end. Language is plain and clear. Okay, so you can just start reading it. Wherever I feel I need to speak something, I'll speak about it. But there's not much in this. Okay, I'll just talk you through it. You can just read it from there and listen to what I'm saying. So you already know this. When the department has to proceed to the DRP, okay, that you already know. So once the draft order is ready, In case of eligible SSE, you already know who is the eligible SSE. Then in that case, they will have to present this draft order to the DRP. Okay. If the SSE is finding it prejudicial, then within 30 days of the receipt of the draft order, he will either give his acceptance or he will file his objection. And he will do so with the DRP as well as to the assessing officer. If SSE is not replying within 30 days, or if he gives his acceptance, then there is no problem. Then assessing officer will proceed with it and close the assessment. And for closing this assessment, the assessing officer will get 1 month from the end of the month in which acceptance is received or the period of filing of objection expires. So till now we have only studied 2 times 30 days period. So SSE also gets 30 days to challenge, and department gets, the tax authorities get 30 days time from the end of the month to complete the assessment. If matter goes to DRP, then they might call for further details and they might give their judgment based on these points which are given in A, B, C, D, E, F, G. Draft order they will consider the objections, they will consider the evidence furnished, the report, if any, of the assessing officer or TPO, records, whatever they want. They can do further inquiry if they want. And DRP has the powers to confirm, reduce or enhance the variations proposed in the draft order. Okay. Any directions, point number 11 I'm talking, any directions given by DRP should be done only after giving a reasonable opportunity of being heard. If it is prejudicial to the SSE, he should be given an opportunity of being heard. If it is prejudicial to the interest of the revenue, then department should be given an opportunity of being heard. Just revise it, and then after that we will start with our next big section, that is section 147.